Hey, good evening, fellow traders. What's happening? I hope everybody had a good day today. Uh, I know my schedule is just full bar. I'm dropping these videos late, but hopefully you're finding time during the day or the next day to watch it. Today is going to be something a little different. I had a lot of requests, a lot of questions about what I talked about last night in the video. So I said, I can't really teach the whole class, but I've got an excerpt from our Roadmap to Success program that I'm going to share with you on the 5 minute opening range. And it's, a strategy that I use, and that it was the first strategy that I became really proficient with. And I still use it today. I trade it every day when the opportunity presents itself. So we're going to go over that today. But before we get into it, let's talk about the market real quick, because like I've been saying, we need to stay on top of what's happening in the market. And, I'm kind of nervous here. I want to see it. I really feel the Bulls are going to run it to 340. They may even take it to 350. But we are due for a healthy pullback. Things are not, and I'm not a conspiracy theorist, but everybody knows things are not as good as they seem. We are in a recession. Our GDP is over 30% less than what it was last quarter. And our GDP is two-thirds made up of consumer spending. So that means consumers are not spending. And we talked about where they're putting their money in Robinhood, and they're probably saving it. So a lot of people are putting their money to work in the market. The market is doing really well for, first time and newer investors. Day trading is always going to be day trading. It's always going to be really tricky. But we're talking about swing trading. We're talking about holding it for stuff for several months, or building up long-term investment positions. And that's where a lot of the consumer money is going. I think we made a really good case as to where it's going. And then we look at the jobless claims. Now, we did, for the first time in a long time, we've got less than 1 million initial unemployment claims. Okay, and everybody was all over that. But you got to look at the continuing claims. That's over 15.5 million. So we still have over 15.5 million people unemployed, out of work. Now, granted, that number is down about 500,000 or 600,000 since last week, which is good. We had that many people go back to work. But here's what's happening. You have people that were initially on this. They go back to work. They end up getting sick or have to quarantine because they were around employees that were sick. They're out for 2 weeks. They've got to reapply. Or if they're already in the system, it's not going to count as a new claim. It's just going to be a continuing claim. And I know we have several friends whose kids were working and they all became infected. The kids were infected with the virus. A couple of them were really sick. And they had to quarantine, so they had to go back on unemployment. The parents had to quarantine, and they had to go on unemployment. So, and it's just something that's just going to keep, going back and forth. And what really scares me is what might happen with everybody, with all of our children going back to school. Now, the older kids can get really sick. Some never showed a symptom at all. They just had the fever and stuff, and they tested positive, maybe some sniffles. And others, same age group, got really sick. And you don't know. That's the scary thing. You don't know how it's going to affect you. And so what's going to happen when schools open up and it starts spreading through the schools? It's already happening in Georgia. Terrible. But what's going to happen when a class has to get quarantined for 2 weeks? The teacher's not there. You're not going to be able to get another teacher in that classroom. You're going to get a substitute. And substitutes, I know in South Carolina, they're just babysitters. That's all they are. They don't teach. They don't know the subject matter. They don't teach. They're just there to monitor the students. And so that's a worse situation than actually learning online, where you have your real teacher there instructing you and all of that. So it's kind of crazy. That worries me. But, just to sum it up, I'm on edge every day. I don't know what's going to happen from one day to the next. That's what makes it exciting. But we just have to be prepared. So stay on top of everything that we talked about. Keep your eyes open, because as day traders, as short-term swing traders, we can make money no matter what the market does. We just need to stay in tune and make sure we're on the right side of things. All right, so getting into my 5-minute opening range strategy. So you guys, most of you know, I like the simple trading methods. Everything I do is simple. The swing trade strategies I teach, very simple. Day trading, very simple. I do have some more intuitive strategies that they're even simple too. Once you learn how to read price action and you develop the discipline and everything you need, I share those with you. I teach those strategies personally one-on-one. So everybody is there, they got that. But those are simple too. And the reason why I focus on simple strategies is because, contrary to popular belief, complex strategies don't equal more profits. They don't equal more consistency. Actually, the more complex, the more difficult it is to interpret, execute, and manage. So I'm a keep it simple, stupid person. I'm all about the KISS method. And I've made it to where I am right now because of the KISS method. So I'm all about sticking to the basics. Now, this 5-minute opening range, well, let's just say the opening range strategy, because people use different time frames. Some start at 30 seconds, 1 minute, all the way up to 60 minutes. They trade off an hourly chart. But this simple entry strategy has been around for over 50 years, and it remains one of the most popular entry strategies to this day. One of my mentors right now is a retired trader. He started in the pit at the bottom, and he managed several funds. So he was in it and kind of worked his way through coming off the floor to being on the computer. And so he's got a wealth of experience. And he says the opening range strategy was there when he was there, and it's going to continue. So you just have to be fluid with it. So, he told me about that. Now, the opening range basically is the highest price and the lowest price traded during whatever time frame that you're measuring. For us, it's 5 minutes. this particular trading period, it is important because it often sets the tone for the remainder of the day. It doesn't always, but it often does. Between the closing of the previous trading session and the opening of the current session, anything can happen. Anything can happen. And that's why I'm looking at the SPY. Like right now, I'm looking at the SPY trading. On Thinkorswim, it runs 24/5. So I could trade the SPY right now if I wanted to. But I watch it, and if I wake up in the middle of the night, I'll look and see where it's at. Because anything can happen. Any events can happen overnight. Some government reports could come out, earnings, we know about that. Stuff can happen overseas that can have an influence on the market. How many times have we woke up over the last year and something that happened with China, we got stuff gapping up or gapping down. And that's what I'm talking about. So these events can have a major impact on the trading session. And a lot of times, everything kind of comes to a head at the open. And we're able to determine what it's going to do, at least the first part of the day. It may not be the whole day, but at least the first part of the day. Stop it! Stop it! Sorry about that. My cats are fighting. But it really it can affect where what we're doing and how we're going to trade that day. So typically during the first half hour of the trading day, and that's the most emotional part of the trading session, and because of that, it's the most volatile. This is the time that the market is absorbing all of that overnight information, and you see that in the price action. So institutional traders come into the market, buying and selling large quantities of shares through computerized trading systems. But here's the thing. 3 years ago, you didn't see a whole lot of action pre-market. Now, there's some stocks that trade pre-market better than they do once the market opens. So we're having a lot of this volume actually starting 8 o'clock, 8:30, and more people are actually trading pre-market. So, and it is kind of taking away and kind of messing up the opening range strategy. But the opportunities are still there. They're always going to be there. The volume, you see it, and you can see it right here on this chart, where right at the open, you get these massive amounts of volume. And, this is what we're trading. This is causing the momentum. This is causing the volatility. And this is giving us the best chance to make some good money. Yeah, it's quick. I don't like trading very fast. I don't, but the 5-minute candle kind of slows things down a little bit and gives me a better opportunity to kind of think through and work through trades a little bit better. So, it's very difficult to really see what impact the overnight market will have until it actually opens. But like I said, there are, it's becoming more and more obvious that stocks are starting to trade really early, and we're able to see ahead of time what the day may be like. So, we have to take that into consideration. So for me, I've got a 4-part trade plan, or anatomy of a trade. Basically, you find a pattern in the story. You're scanning. you're looking for the catalyst. You're looking for the gap, which is the pattern. That's, I'm calling the gap the pattern. And then you find the entry. You know, that's your trade plan. You find the entry, your profit targets, your stop, and then when it sets up, you take a position, you execute. Then at the end, you reflect and analyze on the trade. And that's where true learning takes place. True learning takes place at the end, when you reflect and you analyze on what you experienced in the market that day. And every day is going to be a little different experience. You should pick up something every day. So I use a trade idea scan. I got what I call, this is what I named it, the opening range breakout breakdown pre-market scan. And what it's looking for are stocks that have over 50,000 shares traded pre-market, has a gap up or down over $1. The ATR, I really like it to be over $1, but it's, set at 50 cents. But I really, really would like to see it over $1. Ideally, I like a lower float stock, less than 500 million, but greater than 50 million. I don't like the really, really low float stocks because they could be really unpredictable and, kind of scary to trade. So I tend to stay away from those really, really low float stocks that have a float less than 50 million. The price range, my sweet spot, $20 to $150. Right now, I need to change that. It should be $20 to like $175. That's kind of my sweet spot. I need to see a solid catalyst. The daily chart has to be solid. And I identify that when I vet the stocks. And that's when I analyze the daily chart. And this is what we do in pregame every morning. Starting at 8:30, I'm going to look at my scan and I'm going to start analyzing the daily charts. And then, I'm going to mark the support and resistance levels, which include daily levels, the daily moving averages and all that stuff. And I look for windows of opportunity in between those levels, because we know stocks trade from support to resistance and from resistance to support. And I'm looking for those windows of opportunity. And then the data automatically transfers to the 5-minute chart. So on Thinkorswim, I don't have to do anything different. And I can analyze it there, and I'll determine if it makes the watch list. That's basically what I do. And we do this every morning. So when you guys see me going through this is exactly what I'm doing. And then we make our trade plan. Based on where the stock is trading, you have that first 5 minutes. The last couple of minutes, you can pretty much get an idea of where the stock is going to put in the high and the low. And from there, you can identify potential profit targets. You want to look at where would be an ideal stop, and then where would the profit targets be. And if the trade makes sense from a risk-reward point of view, then all you do is wait for it to trigger, and you take the trade. And what I did, I have this here. This is what I used to write down when I first started, because what was happening is I would have a trade plan, and then when the bell rang, my mind would go blank. It would be that deer in the headlight look, which was, really scary. So I had to write this down. And yes, this takes time, but what it did, it forced me to slow the hell down and be more meticulous about my trades. And that made a lot of difference. It helped with my discipline, and I can't tell you how much this helped me out. This simple little And all it was a note card. You know, I got stacks of them because I was working as a teacher. I was doing this alongside my day job. And so, of course, I had mounds of note cards to use, and I made good use of it. And then we execute. And so the simple conditions that needed to be there for me to execute the trade. Number one, the first 5-minute candle has to print. Then the stock needs to have broken out of that 5-minute opening range by 10 o'clock. Now, if it goes after 10 o'clock, 10:15, it's a different type trade. It's a different strategy by then. That's the second strategy that I teach. The quicker the market breaks or the stock breaks above or below the opening range bracket, the better the odds of the trade working out. But most breakouts that occur later, like after 11 or 12, they don't have enough volatility to sustain a large move. And more than likely, it's going to be a trend continuation trade. And those you have to manage a little differently because you don't have the momentum or the volatility. And, you have to take that into consideration. Also, I need to see a bias toward one particular direction. I need to see it giving me a good indication that we're going to trade short or long. I often see markets swing back and forth between the high and the low of the opening range. Those I stay away from. The majority of the time when I see that, I just say, nah, this isn't, and I drop it from a watch list and I look at some other stocks. Now, I'm going to say this. Not all the time does that stock fail. There are times when that stock gets itself squared away and it makes the move. But more times than not, it's not going to make it. And every decision I make is based off of what's it most likely to do, over a period of time. Is it going to work more times than not, or is it not going to work? And that's how I make my decision. So the ideal market action prior to breaking out of the opening range, you want to see the smaller time frame, because I use a 2-minute chart. Some people use a 1-minute chart. I want to see it making higher highs or higher highs and higher lows if I'm going to go to the upside, or lower lows and lower highs if it's going to go short. I want to see it putting in that pattern on the shorter term time frame, because that's going to give me the confidence and a good indication that the stock's going to go in the direction that I want it to go. If it's jumping around and bouncing around, then that's the one I'm just going to stop looking at and move on to one of the other 2 or 3 that I have on my watch list. All right, so I don't want to see a stock that keeps going back and forth. I just don't. That's just a sign to me to stay away. The last condition is volume. I want to see a volume breakout. And that automatically you're going to see that. But some stocks do not pick up volume at the open. And that means people are not trading it. They're not interested. So if it's not picking up volume at the open, I'm not trading it. It's best to just stay away from it. So the vast majority of the time, the market's going to peak during the first 15 minutes and the last 15 minutes of the trading day. Well, really the last 30 minutes of the trading day, because most brokers have a 2-to-1 overnight deal, and sometimes people have to get out or reduce their position size so that they fall and not trigger a margin call. So the last 30 minutes is probably what we see a lot. we see a lot of the volume pick up. So my solution to deal with the volume drying up is simple. As long as the volume is dropping off gradually and it's still within the range that existed during the defined opening range, I don't consider it a trade breaker. Okay, so I monitor the volume and the price action. If it still looks good, I'm going to take it. If, however, I find that the volume is barely moving compared to how it was during the defined opening range, I'll think twice about it. I'll make a decision before it actually triggers and then walk away. All right, so you execute, you enter when the setup triggers. All of the thought process and the thinking and the decision making should already be done. All you're doing at that point is waiting for it to set up the trigger. When it triggers, you get in. If you don't trust yourself, you put in your stop. I don't recommend putting in a hard stop immediately. I recommend waiting 1 or 2 candles if you're going to do it. But definitely put in your profit targets first. I can't tell you how many profit targets I missed because I didn't put it in and it ran to my target and never came back. And I would have at least had a base hit on it. But then you do that and you just sit back and you wait for the trade to work. No need to, I cry, bitch, moan, and complain, but that's just the way I deal with the time. I'm not going to, change anything. I'm not going to do anything different. It's just me dealing with what I'm dealing with. But it's not going to make me change my approach. All right, so this is one we looked at last week. I mean, not yesterday, not last week, yesterday. This is the one that I showed you where the first 5-minute candle print, we printed, waited for the next candle to close below the opening range low, and then once this candle confirmed a loss of the opening range by trading lower than the candle that closed below it, I get in. It's a no-brainer. You take it. And you start hitting your predetermined profit targets. They should already be predetermined. All of these targets were predetermined prior to me getting in. Now, do I adjust it sometimes when I see support? Yes. And I try to point that out to y'all. That's why it's so important that you there watching me trade live. You watching the trade happen right before your eyes so you can hear what I'm thinking and understand why I'm making the decisions I'm making. Because you have to learn how to do that. And there are going to be times where the price action dictates you bailing out. And you have to do it. Because our number one priority, our goal is to make money. So all of these were predetermined. And the strategy is as simple as it can get. The hard part is executing it right every day. All right, so that was yesterday. Well, full disclosure, I pretty much lost this today. We're not doing a recap today, a full recap, but I'm going to tell you that's about what I lost today. So whatever I made yesterday, I gave it back today. So LYFT, this is a trade I took this morning. All right. And here's using the same theory, being conservative, using the conservative entry. This is the opening range low. Here's the first candle that closed below the opening range low. And once it broke the low, I took the trade. But I made a mistake. This trade didn't fail because the strategy just didn't work. I never should have taken it. This wasn't a legit opening range breakdown setup because I forgot about this support. I never transferred this to my DOS chart. And so when I got in, when I looked over at my Thinkorswim chart that has all my levels and stuff on it, it's sitting there right in my face. I shorted into support. That's a no-no. So here's how easy it is to make a mistake. And remember, I told you yesterday, 90% of losing trades are trader error. You make a little silly mistake, you overlook something. Now, I was in 2 trades at one time like a dumbass, and this is why I messed up. I rushed this because I got upset at before we look at the other trade, I want to make sure that I covered everything. So the reason why this failed, and this never should have been an entry, is this level right here. And had I not identified it immediately, when I did my reflection at the end of the day, I would go back and say, well, why did this stock bounce here? Is there a level I missed? And I go back and look, and I was like, here it is. I missed the damn level. If I had seen it here, I never would have taken the trade and never would have gotten stopped out on this. It wasn't a bad loss. I mean, I got in at 28.79. Only about 50 cent loss. So not bad. Not a bad loss, but a bad trade, period. And here's the trade I took this morning. This was the first one. I got this on the aggressive entry. Here's the first 5-minute candle. I wanted to be aggressive this morning because pre-market kind of gave me that indication. So I get in on the break, and it runs up. It doesn't quite get to my target. My target was 135. It didn't quite get there. It came really close, but didn't quite get there. When it came and we started to sell, I went ahead and grabbed some profit. I took 2/3 off because I already had a point. Okay, I was looking for over 1.5 points, but I already had over a point locked up. And so I didn't want to give that back just because I couldn't get the last 40 cents. So I went ahead and took 2/3 off, and then we pulled back, and this is a base hit. Okay, so we locked in a little over $200 on this, on a base hit. So what I should have done, because after this trade, I got mad because I thought this thing was going to explode. That's when I ran and jumped in LYFT. Before this even stopped out, I jumped in this LYFT like a dumbass. You don't do that. But I did, and what it did was it kept me from catching this again. Okay, in this second move, the entry was right here. And I would have gotten in with around, let's just round it up to 136. Over 4 points. Over a 4-point move, I gave up chasing peanuts. But I'm showing you this because this is how powerful this strategy can be if you trade it correctly. And today, I wasn't locked in. I let the one thing that bothers me, losing doesn't bother me. What bothers me is missing out on a big move when I'm in the stock. Or when the stock was on my watch list, it was on my eye, I might have even traded it. And I didn't stay locked in, and I missed a big move. This pissed me off, and that my day was done. This is my demon here. This is what I have to work on, is missing big moves on stocks that I was in, that I was locked in on, that I took my mind off of to go chase something else. And I could have had $1,000 day today instead of losing 500. Now I took BA on a trend continuation. It's a beautiful setup, but again, the market turned on me as soon as I got in, and that was that. But that was NVAX. That was today, and here's another one here. This is a more aggressive entry as well. This is one where here's the opening range low. Here's the one we sold through it and closed below it. Instead of waiting for it to break the low of the wick, I went ahead and took it at the body. Okay, this is a more aggressive entry, and you can see hit one profit target. It bounced. It looks like it was reversing, and I ended up taking it off because I was reading a reversal. And again, this is what can happen if you get out of sync. I got in here on a different trade, a different strategy, and this time the reversal did come in and I took it off again. So basically the same thing I did here, I did here. It's just that this was a fake and this was the real thing, as you can see. But the key and the reason why I put this one up is because these trades will look different. It's the same simple strategy, but each stock is going to have its own little idiosyncrasies. It's going to feel different, even though we're looking for the same strategy. And that's why I feel it's so powerful that you guys are able to watch me execute it, so you could learn from a lot of these things. And that's why I recommend, if you learn a strategy, that you spend several months focusing on it, because you need to trade it through different market cycles, and you need to learn how, learn that it's not all stocks are going to trade the same. Every trade is probably going to trade differently, feel differently, move differently. It's going to tap the different hairs on your neck, and it's going to make you feel a certain way every day, and it may not even be the same way. So experience, screen time, that's key. All right, but it's simple strategy. It's what got me out of my little account and helped me grow. And the more you grow, the more size you can take, and it's all relative, because as you grow, you're gaining experience, you're gaining confidence, you're able to incur more risk, so you can raise the position size without throwing anything off. And I do recommend, until you get to a point where you're just happy with what you make, I do recommend raising and testing your limits on your position size, so you can get to the point where you could be the most efficient and the most profitable. But it all comes in time. It's a process. But all of this strategy is 100% scalable, and and I do it. I trade the same strategy in a larger account with more share size. It's nothing for me to take 1,000 shares on BA and trade the opening range, or trade a trend continuation or a reversal. It's nothing. Now, 5 years ago, I'd be terrified. I could do 500, maybe even 600. But I had to work my way up to 1,000 shares on a stock like BA or Roku or something like that. But that's everything. Yeah, that's everything. So I hope on what I shared with you, you have a good understanding. Like I said, the class is more in depth. It takes a little bit more time, and then you get to see me actually actually trade these strategies every day. Win, lose, or draw. You know, we had really good days Monday, Tuesday, and Wednesday. You know, you guys got to see me lose $500 today. And I think I might have made $2,000 over the. No, I don't think I made that much. Maybe $1,500 over the last 3 days, and I gave back a third of it today. I mean, that's just the way it is. So, in looking for a stronger day tomorrow, if I pick up a couple of $100 back, hey, that's great. But I'm green, and at the end of the month, I'm gonna be green, and we're just gonna keep building from there. So, definitely, if you have any questions from here, shoot me an email. Ed@AverageJoeTrader.com. I'll be happy to answer anything for you. So, you guys have a great night, a great evening. I hope this helps out a little bit, and I will catch you in the morning.